So what I've got here is just a visual representation of an information system, okay? Because I want to show you that it's not this complicated concept. If we have to put information system into layman's terms, it would be a system that stores information. Cool? So that's quite simple, it's quite easy. What specific information are we talking about here? Well, if we are looking at the information system as auditors, it's the information that affects the financial statements. Because what is our end goal? To express an opinion on the financial statements. So what are the type of things, or type of information that sits in the financial statements? That's the F's here, guys. Revenue, bank, PPE, expenses. These are examples of the type of information that sits in the financials. So they have to have a system that gets that information into the financials. Because you can't just make a number for revenue, although some companies do. You shouldn't. There has to be support for why that revenue amount is what it is, and that bank amount and that PPE amount. So all this is saying is, how do they support what's sitting in the financials? And ultimately, what would happen is that a transaction needs to take place. They need to sell something to a customer in order for revenue to take place. They need to buy an asset in order for PPE to grow. So transactions need to take place, and they now need to store how that transaction takes place and allow that transaction to move through a process to land up in the financials at the end. And so, an example of what the information system would look like is, there would be source documents that justify the transaction. So in your revenue, if we're talking revenue here, there would be an order from a customer which eventually would result in an invoice. Okay guys, I know there's lots of documents that take place before the invoice, but we're just trying to look at a simplified version of a system. So they've got source documents. That final source document being the invoice means that transaction has taken place. It's finalized. It can now be recorded. When the order comes in, they haven't given the person the stock, so it's not yet a transaction that results in revenue. Only once they've given and they can invoice can they do so. So when they've got this invoice, they can now go and record a journal for revenue. So the information from the invoice resulted in a journal being recorded. This here, guys, is master file. So again, I'm just trying to include all the different elements in an information system, but I don't want to complicate my example here. So in this case, revenue transaction would be recorded in the journal, and maybe the price from the revenue would be in the master file where they can get that information. Then, the end of the month, journals get transferred into general ledgers. And at the end of the year, general ledgers information goes into a trial balance, and they use the trial balance to generate those financial statements. And we as auditors come in and audit those financial statements, but again, we can't just look at this revenue figure and go, this looks right, or let me see if there's any misstatements there. Just by looking at that, we need to take that full amount, work all the way back through to the source documents to make sure that what's in that revenue amount has a valid proof of transaction in order for it to be there. So this is how they go about recording their balances and transactions. Okay? I need to understand this because this is where I can start to potentially find problems. They don't have source documents, or nobody is checking the journals. So there could be issues from the transferring of the information, the source document, to the journal. Or they don't have access controls over the general ledger, which means anybody can change what's in the general ledger. So I need to understand this process, how they go about recording it, because that's going to help me to pick up risks. But what I also need to understand is what controls they put in place here to stop those risks, because that's going to help me to see if the risks I initially thought could take place have been stopped. So things like having different people responsible for different stages. In this process, the person who takes an order is not the same person who gets the invoice, is not the same person who creates the journal, is not the same person who creates the general ledger, TB, or the financials. They have different people throughout the different stages. That makes me a little bit more comfortable, because if one person's doing everything, there's huge room for errors and also manipulation. I need to understand if their source documents have a numbering system to ensure that they don't leave any out. So that's important for me to understand there. I need to understand if they constantly check. Do they reconcile through the process, through the system? So do they go and match the journal to the source documents? And do they then go and match the general ledger to the journal, and match the trial balance to the general ledger, and ultimately match the financials to the TB? Or do they just assume it's right and move on? So I need to understand how it works, just in a nutshell, without anything there to help errors. And then I need to understand, do they have things in place to stop errors? And those things we're talking about here, and just have a few examples over here, are the control activities. So I need to understand the actual system itself, and then what they've put in place to make sure that there are minimal errors in that system. Alright, so control activities are put in place to address the risks of misstatements in recording transactions. Okay, so that's why we've just seen them. They're recording the transaction through the information system. There were some control activities that were there to try and make sure that that information went through free from misstatements. I want to ask you now, what are the risks in recording transactions? And I've put down 3 points here. So there's 3 risks I'm looking for. So the first risk is that you don't record all the transactions that are supposed to be recorded. So it's supposed to be recorded, but it's not. And so ultimately, it's then understated. And then obviously we've got the opposite risk there, where you record something that shouldn't be recorded. And this could be because it's a duplicate and ultimately should not have been recorded in duplicate, or fictitious, a fake transaction. So that's how they would record something that they shouldn't be recording, and ultimately this would lead to overstating. Or you record a transaction that's supposed to be recorded, you just record it incorrectly. And guys, when you think about a journal entry, when you're recording your debit and your credit, the entry will be date, description, amount in debit and credit. So it could be recorded incorrectly in terms of amount, or the date could be wrong, or the details could be wrong. So it goes to the incorrect account. So the control activities that management can put in place will address these risks. Because there's no real other way that the transaction could be misstated. Because guys, for this one, recording it incorrectly, it could be understated or it could be overstated. The amount could be under. They could record it in the wrong account, so the wrong account is therefore overstated, and the account it's supposed to be recorded is understated. Or date, and if the date is in different financial periods, then in the correct financial period, if it's not recorded, it's understated, and in the next financial period, it's overstated. So this is how transactions can be misstated, and therefore they need to have controls to address all of these risks. And if they have controls that address all of these risks and they are all present in the information system when recording a transaction, there shouldn't be misstatements. So guys, the control activities are authorization. That's an obvious one. If somebody is authorizing, they're checking, they're more senior, they're accepting what is on that transaction and it's going through. Reconciliation, we saw in the information system, where you match from each point in the cycle to the next one. So, journal gets matched to general ledger to TB, TB to financials. Constantly you are reconciling between two to make sure that both are correct. Segregation of duties, we discussed once again in the information cycle. Making sure that you've got different people performing different roles so that they're constantly checking and somebody doesn't have the ability to process something from start to the finish in the financials. Access controls. Physical access controls are going to be for the safeguarding of your assets. So that's not a control over transactions, it's over assets. But it's a control that they need to have for their assets. Other access controls, so access to your documents, your source documents and so on, that's going to prevent fictitious transactions being recorded. And then good source document design, making sure documents are pre-numbered. Those are very important to make sure that you're recording in a sequence so that missing or duplicates are identified. So for each of these control activities, guys, I want to go and link it to the risk above. So authorization is there to ensure that only what should be recorded is recorded. So to prevent fictitious transactions from being recorded. So it's there to address risk 2. So I'll just put here the risks addressed. Reconciliation. Reconciliation from one to the next is going to make sure that it's recorded correctly in terms of amount, date, details. Reconciliation from a batch backwards is going to help identify anything that has not been recorded that is supposed to, and anything that was recorded that shouldn't be. So reconciliation is like a powerhouse control because it addresses all 3 risks. 1, that everything that should have been recorded has been. 2, that anything that shouldn't have been recorded is not and will be removed. And 3, that the details are correct. Segregation of duties. So making sure that somebody else is there, checking the work, splitting the functions, preventing the errors that if one person is doing it by mistake they leave something off, or intentionally leave something off or include something they shouldn't. And because you've got different people, they can make sure it's done correctly. So again, another powerhouse control. Your access controls, if we're talking physical, for assets, so your security type controls, this is for the safeguarding of assets. If we're talking access controls with regards to your source documents, then this is to prevent documents going to somebody who doesn't have the authorization and then creating transactions that shouldn't be. They were never meant to be. So it's going to help with the fictitious. And good source document design, pre-numbering documents so that you can always follow a sequence, identify any documents in the sequence that are missing, identify any duplicates. So, missing and duplicates for 1 and 2. So you can see there, guys, a lot of these controls cover more than one risk. So they are so important in the processing, in the initiating, in the recording of any transaction. You want to see all of these controls. And when it comes to the physical assets that they have on their premises, whether it be in their administration departments or their warehouse, you want to see those access controls to safeguard assets. So guys, above here, I had a note here. What are the risks of misstatements in recording transactions? We had those 3. Then you can go and add, there's an additional risk that's not for transactions. So the risks for assets is that they are stolen. And so they need to have a control that safeguards them. So I'll put this as number 4. And that will be over here for your assets, not transactions. I've then said you need to be able to link each control activity, so these above, to the assertion. And guys, that's easy because we've just discussed the risk. So provided you have a slight memory of your assertions, you can link the risk to the assertion back to the control activity. I've made it a bit easy for you in doing it over here, so you can see this, guys. Please spend some time on this table. Don't just go, oh, the table's there, I'm done. The table is going to help you, but it brings everything together. We're going to focus on the assertions next week when we do risks at the assertion level. So you'll be a little bit more familiar with them next week, but you can see they're here. Occurrence, completeness, accuracy, cutoff, classification are your class of transaction assertions. So assertions over transactions. And existence is an assertion over your assets. So to address the risk that they record fictitious, we already said there must definitely be authorization. The risk that they record duplicates, pre-numbered documents will assist. And then reconciliation will help to identify where they've put something in that shouldn't be there. So 3 controls that are there to ensure that they don't overstate, and the assertion that is therefore implicated is occurrence. The risk that they don't record something that they're supposed to record. Pre-numbered documents and reconciliation are going to help, because if sequence testing of documents picks up a missing document, they can see that something that was supposed to be recorded has not been. And that will then ensure the completeness of the transactions. That is the assertion. And then the risk that it's recorded incorrectly in terms of amount, a date, or details. Reconciliation, segregation of duties is going to assist there. I've put there RT controls, but guys, we're only doing that next test, so don't worry. And ultimately your accuracy, cutoff, and classification assertions, depending on how it was incorrectly recorded. Was it amount? Was it date? Was it details? And lastly, theft of an asset. So now we're not dealing with a transaction. This is an asset. Safeguarding of assets, access controls to ensure the existence of the asset, not a transaction. Look at the middle. Control objective, guys. We've got the inherent risk. Look at the objective. The objective is to ensure that the assertion is achieved. So, authorization is there to ensure the occurrence. And pre-numbered documents to ensure the occurrence and completeness. And reconciliation to ensure the occurrence, the completeness, the accuracy. So I've put here the control objective, and you will see that the purpose of the control is to achieve the assertion. The assertion that it is recorded and should be recorded. It's not fictitious and it's not duplicate, therefore it did occur. The assertion that it should have been recorded and it has been recorded, so it's complete. The assertion that it's recorded correctly in terms of amount, it's accurate, date, cutoff, and details, the classification of it. And then to address the risk of theft of an asset, access controls will ensure the existence. So you could even say control objective to ensure the existence of the assets. The objective aligns with the assertion, because the purpose of the controls is to prevent the misstatement, thereby making that transaction or asset correct, free from material misstatements. And in which way, which assertion is it trying to achieve? Guys, before we go into the business cycles for each of the transactions and then assets and liabilities, I want to take you into the standard so we can see where understanding internal control fits in, where everything is highlighted that's important. So you can go and highlight your books. Then we'll go into the cycles to see how these controls are implemented in the initiating and the recording of the transactions.